The housing market hasn't just slowed down, it's completely frozen. Today, we're going to show you exactly why homes are sitting on the market longer than any time in the last 5 years. And more importantly, home buyers and investors can take advantage of this historic shift. What I'm about to share isn't just theory, it's backed by shocking new data from Redfin that most people haven't seen yet. We're witnessing the biggest collapse in housing market activity since the pandemic began. Let me paint you a picture of what's happening right now. The typical home in America is sitting on the market for 54 days before getting an offer. During the pandemic buying frenzy, homes were flying off the market in 35 days. This shift represents a complete transformation in market dynamics. Here's what makes this market truly extraordinary. We're seeing 5.2 months of housing supply. To put this in perspective, anything above 5 months typically signals a buyer's market. We haven't seen inventory levels this high since February 2019. Let's dive into the fascinating regional differences this market freeze has created across the country. The Redfin data from January 26th reveals a tale of dramatically divergent markets. In Pittsburgh, we're seeing an astounding 19.3% increase in median sale prices, while just a few hundred miles away in other major metros, the story couldn't be more different. Milwaukee follows close behind with a 16.7% price increase. And Fort Lauderdale has surprised many analysts with a 14.2% surge in prices. Newark rounds out our top performers with a 13.4% year-over-year increase. But here's where the market divergence becomes truly fascinating. While these cities are experiencing remarkable growth, San Francisco tells a completely different story, with prices dropping 5.6%, the steepest decline among major metros. Austin, once the darling of the real estate market during the pandemic boom, has seen prices fall 2.6%, while Tampa shows a 1.5% decline. These contrasts create what we call opportunity arbitrage in today's frozen market. The pending sales data paints an even more striking picture of our frozen market. Portland, Oregon stands alone with a 9.7% increase in pending sales, while Miami has experienced a staggering 24.9% decline. Detroit isn't far behind with a 24.5% drop, and Atlanta shows a concerning 22.7% decrease. San Diego and Houston round out the major declines with 20.1% and 19.8% drops respectively. When we look at new listings, the data reveals another layer of our frozen market's complexity. San Jose leads the nation with a 23.4% increase in new listings, followed by Phoenix at 19.5% and Seattle at 15.2%. Oakland and Sacramento complete the top 5 with 14.5% and 14.2% increases respectively. On the flip side, San Antonio has seen new listings plummet by 17.4%, Detroit by 16.6%, and Newark by 14.4%. This regional data becomes particularly significant when we consider the months of supply metric. We're currently seeing 5.2 months of supply on the market, the highest level since February 2019. This represents a significant shift toward buyers' market conditions, but the impact varies dramatically by region. These regional variations create what we call strategic buying windows in specific markets. This kind of market divergence creates unique opportunities that we haven't seen in years. This dramatic variation in market conditions, from Pittsburgh's 19.3% price surge to San Francisco's 5.6% decline, leads us to a fascinating discovery about seller behavior in this frozen market. While the numbers tell us what's happening, understanding the psychology behind these shifts reveals why sellers in different regions are making dramatically different decisions. Now, let me share something fascinating I discovered while interviewing 20 sellers whose homes have been sitting on the market for over 100 days. We've identified what we call the seller panic timeline, and understanding this psychology gives buyers and investors an enormous advantage. The evolution of seller psychology in this frozen market follows a fascinating pattern that creates opportunities for savvy buyers. In the first 30 days, what we call the denial phase, sellers typically maintain unwavering confidence in their pricing. They're convinced their property stands apart from others languishing on the market, leading them to dismiss reasonable offers that they'll later wish they'd considered. As we move into days 31 through 60, we enter the anxiety phase. This is where the first cracks in seller confidence begin to show. The reality of carrying costs and missed opportunities starts to weigh heavily on sellers' minds. We're seeing initial price reductions averaging $27,500 for median-priced homes, and sellers begin entertaining offers they would have immediately rejected just weeks earlier. The reality phase emerges between days 61 and 90, marking a significant shift in seller flexibility. This period often coincides with sellers missing their original moving dates or financial deadlines, forcing them to consider creative solutions. We're seeing increased openness to seller financing, rent-to-own arrangements, and substantial closing cost assistance. This phase represents a crucial turning point in the negotiation dynamic. Perhaps most interesting is what happens after day 91. In what we call the capitulation phase. This becomes the prime window of opportunity for buyers and investors. Sellers at this stage have typically exhausted their original plans and are facing the harsh reality of an increasingly frozen market. They're not just more flexible on price, they're often open to creative financing arrangements and substantial concessions that weren't on the table during earlier phases. The current market reveals three distinct types of sellers, each requiring a different negotiation approach. First, we have the must-sell group. These are sellers facing life-changing events like divorce, job relocations, or inherited properties they can't maintain. They're typically the most flexible on both price and terms, often accepting offers significantly below their original asking price. Then there's the wait-and-see group, comprising financially stable sellers who can afford to be patient but are increasingly concerned about the market direction. While they're making modest price adjustments, they're primarily testing the market's temperature rather than aggressively chasing a sale. Finally, we have the market testers, sellers who have listed their homes out of curiosity rather than necessity. They're the least likely to make significant price adjustments, but they're also the most likely to withdraw their listings if they don't get their desired price. What makes this market particularly interesting is how these seller psychology patterns create windows of opportunity for buyers and investors. Our analysis shows that timing your offers to align with these psychological shifts can dramatically improve your negotiating position. The sweet spot typically falls between days 75 and 105 on market. That's when sellers have moved through enough emotional phases to be truly receptive to creative offers, but haven't yet withdrawn their properties in frustration. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Let me take you through 3 properties that perfectly illustrate what's happening in today's frozen market. The first is a luxury home that epitomizes the high-end market freeze. Originally listed at $1.2 million in October, this property is sat untouched for 95 days. The seller, a relocated tech executive, just slashed the price to $899,000, a reduction that would have been unthinkable just months ago. What makes this particularly fascinating is how it reflects a broader trend we're seeing in the luxury market, where carrying costs are forcing sellers to make increasingly aggressive price adjustments. Moving to our second property, we find a compelling story in the mid-market segment. This 4-bedroom home in the suburban corridor was listed at $425,000 during what the seller thought would be a strong fall market. After 3 price reductions and 142 days on market, the seller has now introduced a creative financing package that includes a 2-to-1 buy-down and substantial closing cost assistance. This property perfectly demonstrates how mid-market sellers are adapting to the reality of higher interest rates by essentially buying down their buyers' mortgage rates. Perhaps the most interesting case is our third property, a starter home that reveals a fascinating shift in the first-time buyer market. Listed at $275,000, this property has been available for 180 days, and the seller's journey mirrors what thousands of others are experiencing nationwide. Initially resistant to price reductions, they've now not only dropped their price, but are offering a comprehensive package of concessions that effectively brings the real cost of purchasing down by nearly 8%. The real estate landscape in this frozen market is creating distinct patterns of opportunity that savvy buyers and investors are beginning to recognize. Take, for instance, the surge in failed Airbnb properties hitting the market. These properties often come with motivated sellers who've seen their expected rental income disappear, creating unique opportunities for both home buyers and traditional rental investors. We're seeing similar patterns with new construction spec homes, where builders are increasingly willing to offer significant incentives to move their inventory. What's particularly intriguing about this market is how different property types are behaving in various price ranges. The data shows that homes in the $300,000 to $500,000 range are experiencing the most dramatic shifts in seller behavior. These sellers, often moving up to larger homes or relocating for work, are caught in a particularly challenging position. They need to sell to move forward with their plans, but they're trapped between their original price expectations and the reality of today's buyer market. Let's explore the specific strategies that are proving most effective in this unique market environment. The current conditions have created what we call a strategic buyer's window, a period where traditional market dynamics have shifted dramatically in favor of patient, well-prepared buyers. Understanding how to leverage this shift can mean the difference between modest and exceptional opportunities. The most successful buyers in today's market are employing what we call the 90-day strategy. This approach begins with identifying properties that have crossed the critical 90-day threshold on market. What makes this strategy particularly powerful is its alignment with seller psychology. After 90 days, sellers have typically exhausted their initial marketing efforts, gone through at least 2 price reductions, and are significantly more receptive to creative offers. Consider the financial landscape in today's frozen market. With rates hovering near 7%, creative financing strategies have become increasingly crucial. The most successful buyers are combining seller concessions with rate buydowns in ways we haven't seen since the high-rate environment of the 80s. For instance, we're seeing a resurgence of the 2-to-1 buydown program, where sellers effectively subsidize a lower interest rate for the first 2 years of the mortgage. This strategy becomes particularly powerful when combined with careful property selection. The current financing landscape tells a compelling story about our frozen market. As of January 23rd, the weekly average 30-year fixed mortgage rate sits at precisely 6.96%. While this represents a slight decrease from 7.04% the previous week, it's still keeping monthly payments at nearly record levels. To put this in concrete terms, the median monthly mortgage payment has reached $2,753, a number that's fundamentally reshaping buyer behavior and seller expectations. What's particularly fascinating is how these financing conditions are affecting actual sales prices and negotiations. The latest Redfin data shows that only 21% of homes are selling above their list price, down from 23% during the same period last year. This shift in pricing power becomes even more evident when we look at the average sale to list price ratio, which has dipped to 98% from 98.1%. While this might seem like a small change, it represents millions of dollars in negotiating power shifting from sellers to buyers across the market. The total number of active listings tells an equally compelling story about our current market conditions. With 889,202 properties actively listed for sale, an 11.3% increase year over year, buyers have more choices than at any point in recent history. This increased inventory is creating what we call a selection premium for buyers, where the ability to choose from multiple properties often translates into stronger negotiating positions. The market activity metrics paint a picture of shifting buyer behavior. Mortgage purchase applications are down 7% year over year, yet, interestingly, Google searches for home for sale have surged 14% in just the last month. This divergence between browsing and buying behavior suggests a growing pool of potential buyers waiting for the right conditions to enter the market. Even more telling is the touring activity data, which shows a 7% increase from the start of the year, nearly matching last year's 8% increase during the same period. This data confirms what we're seeing on the ground. Buyers are actively monitoring the market, but they're being incredibly selective about when and how they make their moves. The median sale price of $377,125 represents a new equilibrium point in many markets, but the path to reaching that price has changed dramatically. Buyers are taking more time, viewing more properties, and negotiating more aggressively than we've seen in years. With pending sales down 7% year over year and active listings up 11.3%, savvy investors are discovering that these market conditions create what we call strategic inefficiencies, gaps between market perception and reality that create unique opportunities for those who understand how to interpret the data. Let's examine how the most successful investors are leveraging these market conditions to their advantage. For investors, understanding these precise market metrics transforms general market knowledge into actionable intelligence. When we know that only 21% of homes are selling above list price, compared to 23% last year, we can craft investment strategies that capitalize on this shifting power dynamic. This brings us to what we call distress arbitrage, a strategy that becomes particularly powerful in markets showing increased days on market. Properties that have been sitting vacant are accumulating carrying costs for sellers creating increasing pressure to sell. This brings me to one of the most powerful tools successful investors are using in today's market. Smart investors are using tools like foreclosure.com to be first to know when foreclosures hit their target markets by signing up for free alerts on foreclosure.com to catch investment opportunities the moment they arise. We've included the link in the description below. This pressure isn't uniform across all market segments, which creates opportunities for targeted acquisition strategies. We're seeing particularly compelling opportunities in markets like Atlanta and Miami, where pending sales have dropped by nearly 25% year over year. The data reveals an interesting pattern in seller concessions. Properties that have been on the market for more than 120 days are seeing average seller concessions of 3 to 4% of the purchase price, significantly higher than the historical average of 1 to 2%. This shift creates opportunities for buyers to effectively reduce their out-of-pocket costs while securing properties at increasingly attractive prices. One of the most powerful strategies emerging in this market is what we call price reduction tracking. By analyzing the pattern and frequency of price reductions, buyers can identify sellers who are approaching their maximum pain point. This isn't just about finding desperate sellers. It's about understanding market psychology and timing offers to align with sellers' increasing motivation to move their properties. The current market also presents unique opportunities for long-term value creation. Properties that have been sitting vacant often present deferred maintenance issues, creating opportunities for buyers who understand how to accurately estimate renovation costs and future market values. This is particularly relevant in markets like San Francisco, where we're seeing price declines of 5.6% year over year, creating potential long-term appreciation opportunities for patient investors. Understanding risk in a frozen market requires a fundamentally different approach than during normal market conditions. The extended time properties spend on the market creates both opportunities and potential pitfalls that buyers and investors need to navigate carefully. Let me share what we're learning about risk management in this unique environment. The current market indicators demand careful attention to risk. The Redfin Home Buyer Demand Index has hit its lowest level since June. Even while touring activity shows a 7% increase from the start of the year, this divergence between browsing and buying behavior signals a market where careful risk assessment becomes crucial. The most successful buyers in today's market are approaching risk management through what we call the 3 layers of protection. The first layer involves thorough property analysis. In a market where homes are sitting vacant for extended periods, we're seeing an increase in deferred maintenance issues. Smart buyers are leveraging this extended time on market to conduct more thorough inspections and multiply property visits across different weather conditions, revealing potential issues that might have been missed in a faster-moving market. The second layer focuses on contract protection. The extended time properties spend on market has shifted negotiating leverage significantly, allowing buyers to structure more protective contract terms. We're seeing successful buyers negotiate longer option periods, more comprehensive seller disclosures, and more substantial repair allowances. What's particularly interesting is how sellers' increasing motivation creates opportunities for buyers to include more protective contingencies without sacrificing negotiating position on price. The third layer involves market timing protection. This is where understanding local market dynamics becomes crucial. For instance, in markets like Portland, we're seeing a 9.7% increase in pending sales. Buyers need different protective strategies than in markets like Miami, where pending sales have dropped by 24.9%. These market-specific conditions should directly influence how buyers structure their offers and protection mechanisms. The timing metrics tell a compelling story about our current market. With only 25.7% of homes going off market in 2 weeks, down from 29% a year ago, and median days on market stretching to 54 days, a full week longer than last year, we're seeing a fundamental shift in market dynamics. When we compare the median asking price of $407,225 to actual sale prices, we get a clear picture of the pricing gaps that create timing opportunities. Let's talk about the concept of market timing in this frozen environment. Many buyers make the mistake of trying to time the absolute bottom of the market. However, the data shows that successful buyers in this market are focusing instead on what we call Relative value opportunities. These arise when individual properties have experienced price reductions that outpace the broader market decline, creating immediate equity opportunities regardless of future market movements. The current market conditions have also created a fascinating dynamic in appraisal risk. With fewer comparable sales and longer marketing times, we're seeing increased variation in appraised values. Smart buyers are addressing this by building appraisal gap coverage into their purchase strategy, either through additional cash reserves or through seller agreements to reduce price to appraised value. This becomes particularly important in markets experiencing significant price adjustments. One of the most overlooked aspects of risk management in this market is what we call future marketability analysis. Buyers need to consider not just today's frozen market conditions, but how their purchase will position them when the market eventually thaws. This involves analyzing factors like location resilience, property characteristics that maintain value in down markets, and potential future development in the area. As we wrap up our analysis of this frozen market, let's focus on the concrete steps buyers and investors can take to capitalize on current conditions, along with what the data suggests about where we're headed. Understanding both the immediate opportunities and longer-term trends will be crucial for success in this unique market environment. The current market freeze has created what we might call a strategic paradox. While overall market activity has slowed dramatically, the opportunities for well-positioned buyers have actually increased. The key lies in understanding how to leverage these conditions effectively. Looking at the most recent data, we're seeing a fascinating pattern emerge. Properties that have been on the market for more than 120 days are now selling at an average discount of 12% from their original listing price, compared to just 4% for properties under 60 days on the market. This brings us to our actionable strategy framework. The first step involves what we call strategic positioning. In today's market, the most successful buyers are building their negotiating position well before making an offer. This means having not just pre-approval, but a fully underwritten pre-approval from a lender. It means understanding the seller's timeline and motivation through careful research and agent communication. Most importantly, it means being prepared to act decisively when the right opportunity presents itself. Looking ahead, the market data suggests we're entering what we call a prolonged negotiation phase. The days of quick sales and multiple offers are largely behind us, replaced by a market where patience and negotiating skill become paramount. The most recent Redfin data shows mortgage purchase applications remain down 7% year over year, suggesting this slower pace will likely continue through at least the next 2 quarters. For those ready to act in this market, we've developed what we call the Frozen Market Checklist. This comprehensive approach starts with thorough market research, moves through property analysis, and culminates in strategic offer positioning. What's particularly interesting about current conditions is how they've created opportunities for buyers to negotiate not just on price, but on terms that would have been impossible in a faster-moving market. Recent data provides crucial context for our market outlook. Mortgage rates have shifted from 7.26% to 7.06%, while new listings have increased to 68,054, up 2.2% year over year. The regional variations are particularly telling. San Jose leads with a 23.4% increase in new listings, while San Antonio shows a 17.4% decrease. These contrasts create what we call opportunity zones in specific markets. Looking at market predictions, we need to consider several key factors. While mortgage rates remain elevated near 7%, we're seeing early signs of rate stabilization. The market isn't likely to see dramatic rate decreases in the near term, but even small reductions could begin to thaw certain market segments. The key for buyers and investors is understanding how to position themselves now while the market remains frozen to capitalize on any further thawing. As we conclude our analysis, remember that market freezes, like all market conditions, are temporary. The opportunities they present, however, can create lasting value for those who understand how to navigate them effectively. The current market environment rewards patience through analysis and strategic negotiation, skills that will serve buyers and investors well in any market condition. Thanks for watching, and watch this one next.